Hello everyone, I'm Rick with AmazingAccuracy.com. Today is November 2nd, 2024. It's currently 11:52 a.m. Chicago time. It's a Saturday, it's almost lunchtime at noon, and I has just been working on my F-date report for the upcoming week for our members. And I thought it was a good time now to release the next lesson in this new series. And in this one here, we are going to talk about cycles. Cycles means different things to different people. And when it relates to trading, there are differences of understanding. I'd like to give kind of a basic, if possible, on the type of cycles that we're talking about here. For example, in the AmazingAccuracy.com membership site. So what we're looking at right now on the daily chart here is Australian dollar futures. I could have picked any market. It doesn't really matter which markets that I pick. What I want to draw your attention to here is these indicators that I have on the bottom here. Let's see if I can, I'm going to see if I just could blow them up. Okay. This here, for example, is the ever popular TTM squeeze indicator. It's an excellent indicator for a couple of reasons. Number one, it gives you an idea of when the market is going through a congestion or compression phase, which it tends to do a lot. That's where you see these red dots, for example. And if you want the theory to it, there's a lot of information out there on TTM squeeze, but in a nutshell, it's when the Bollinger Bands compress inside of, let's say, a 1.5 average trading range Keltner band. So it would fit inside the Keltner band. That's when you know you got a compression going on in the price action. These histogram waves that you see here is momentum. This is usually a reflection of Bollinger Bands. You know, they tend to expand or contract depending on volatility and momentum. And so it's reflected in this indicator. But the reason I'm showing you is I want you to notice that the pattern you see here is not like even. It's like you're not seeing the moves up and down being of equal height and equal duration. In the world of cycles, we refer to the height here as magnitude. So the magnitude, you can see like over here, the magnitude of this bearish momentum is not the same as the magnitude of this bullish momentum, nor is it the same as this bearish one or bullish one, and so forth. The magnitude changes. Also, the duration, that would be the time frame. This changes as well. It could be 20 bars, it could be 8 bars, it could be 15 bars, and then it could be 18 bars. Then, you know, I mean, you can see just using this indicator alone is a wonderful example of representing what is really happening behind price action. What is making the price bars look the way they do on a price chart when they go up and when they go down and up and down, and why it goes up for a long period of time, and sometimes it goes down for a short period of time, and so forth. But notice, every market will be the same as far as having this pattern, but the appearance of the pattern will not be the same. Every market has its own pattern, what makes it go up and down and so forth. Take a look at this. We can see, okay, price is moving down, up. In this case here, it's momentum and volatility, but we're just going to say for the sake of argument that we're looking at price because it is representative of what's behind that price. So it goes down, up, down, up, down, up, down, up, down, up. It's called a cycle. It cycles up and down, up and down. And one complete cycle is the same as a circle. It's 360 degrees. That's what a circle is. I don't want to get too much in the weeds here. It's a subject I love, but it's not a subject easily explained. I'm trying to simplify. The point is that everything returns back to the zero line here that you see in the middle. All right. So you have the negative swing, then you have the positive swing, and you have the negative swing and a positive swing. And it all happens along the zero line of the cycle itself, not zero price, or because we don't have negative prices. There is this line. All right. Now, the indicator, the zero line on this indicator, for example, and basically all oscillator type indicators, which we're going to look at a couple of others here in a second, pretty much are linear. In other words, from left to right, you have a straight line like this zero line right here, and then the cycle just goes up and down across this zero line. In reality, in the world of cycles, this zero line itself would really be its own cycle. It won't be straight across. It will go up and down as well. And then these cycles would ride it as it was going up, and then it would ride it as it was going down, doing exactly what you see here. Try to visualize that. Or I will try to find an image. Let me see if I can find an image so you can see what I'm talking about. Okay, silly me didn't realize that I have a lot of examples right in the membership itself. So let me just pull up the screen here. Okay, this is what it would look like inside the F-Dates membership. This is our membership where our members get the weekly F-Date report, which we'll touch on. You can see it here. It just, as I turn it, it starts to disappear in this camera, but it's kind of in a spreadsheet format that they get every week. Let's just do this, okay? We're going to go straight here to where it says cycle envelope charts. It's updated several times a week. And you simply just click on it, go to the market you're interested in, such as we're looking at Australian dollar. We might as well look at that. And then we get something like this. All right. Now, what I want to draw your attention to is notice that you have this cycle pattern going on right here, that this envelope, cycle envelope, you see in the red, there's a red cycle here. It's a short-term cycle, and it is enveloped in a much larger cycle, this blue one here, which is of a different time frame. And so together you can see that you have one cycle which is faster, that's riding along a slower cycle. And that's this straight line here. Let me get rid of that screen now. This straight line here you can say is the slower cycle that has been stretched straight. But in reality, the markets will have the small cycle, the short-term cycle will ride upon a much slower, larger cycle. And that is what market cycles are. what they are not even ups and even down. You don't have every move to the upside is the same height, every move to the downside is the same height, and the time that they go up is the same always 20 days, 20 days, 20 days. And a lot of people who try to trade cycles in the markets, whether it's futures, commodity, forex, stocks, a lot of them, when they think cycles, they're going, well, we got a 20-day cycle and we have a 40-day cycle. Yes, there is a 20-day, 35-day, whatever. Those cycles do exist. But when you have many of them of different time frames existing at the same exact time, it causes a distortion. Okay, you'll have to Google it about the adding together of different cycle lengths, and you get what is a distorted pattern. And basically, the distorted pattern would be, well, what you see here, all right, or what you see here. It's just a bunch of them grinded together that causes this distorted cycle pattern. If you take this distorted cycle pattern and you detrend it, you'll end up with very clean, even cycles of equal intervals, but of their own. Each of them have their own time frames or frequencies. There are multiple frequencies. But again, we're getting deep in the woods, all right? And I know a lot of you that are not familiar with cycles or this deep type of technology might be going, I need an Excedrin. I apologize, but I just want to give you a little more than just, papering over everything. All right, so let me show you another indicator. So for example, this next indicator, this is an RSI. It's a different RSI than, you could get this one. Let me see if I pull up its name here. It's called Trendio. All right. So you have this Trendio and TMO scalper. Okay, so Trendillo, I guess it's called. These are all indicators that you can use for free in TradingView. This is a TradingView subscription charting thing that I have here that I use. But it's basically an RSI. That's what it is. It's an RSI where they actually Bollinger Band the RSI. But what I want to draw your attention to is notice that it cycles, goes up, down, up, down, up, down, up. And look at how far up it goes, how far it goes back, and so forth. It's not a smooth even, it's all distorted. That's all these oscillator type indicators actually do. Let's get this one. Now this one's even noisier because I have it set to different time frames, and I actually removed a bunch of stuff from this indicator. For example, let me click on it. Let's see. Let me click on its settings here, and you'll see that you can set it like I had set one at 240 hours, and I have one that's the 4-hour chart, and I have this one set to daily, and I have this one set to weekly. There's 3 of them maximum that this TMO scalper indicator will let you do. But I took the weekly off, and I only left the 4-hour and daily on here because it's too noisy for me. But look at this. You see how this indicator is simply going up and down, up and down, up and down. Even the 4-hour in the background, you see, which I purposely dimmed, again, for clarity. But notice how it does the up and down, up and down. And how you interpret this indicator is up to you. I create my own interpretations, and I change it around to what I want it to reflect. And so anyway, this video is not about indicators. You can put 1,000 indicators on here. It's not going to make one hill of difference if you don't know about price action, about behavior of price. And that's what I want to share with you here. All right. So again, what we see on the price chart, what we're seeing is the combining of all these different frequencies of cycles. Now, let's get that out of the way. You now know what creates these chart patterns. That's what creates these chart patterns. If you want to know, well, what creates the cycles, that's a whole different thing. Feel free to ask or Google it or all these other things. You can learn these from J.M. Hurst. You can Google him. That's what these are based on right here. Is J.M. Hurst cycles. That's what I offer for the markets we cover. And most importantly, is the F-date report that I put out, and that is based on the daily and weekly cycles. All right, just 2 time frames is all that I have on this report. Now, this is a printed report. There, you can barely see it right there. I print this on my inkjet printer every week to put on my desk so I can reference it. There we go. Okay, don't disappear on me. I'll just do it right here. Okay, so this report contains the daily for the next upcoming 7 trading days, and it includes the weekly because it's a longer time frame. You get 2 of those on there, the most current and the next one to come, so you can be prepared. So let's now get back to the previous discussion of trends. In that previous lesson, I believe it's lesson 2, you learned that a trend is based on the position, the location of swing tops and swing bottoms. These swing tops and swing bottoms are the result of cycles. A swing top is a cycle top. A swing bottom is a cycle bottom. Easy parcheesi. Now, what is it that we do, for example? Why are these things important? Well, not only where these cycles occur are important, but if you're into market timing, in other words, you want to get in at the best possible time without being too early and get out at the best possible place without being too late, you're never going to get the full trend. But just to get a good chunk of it, that's pretty important. Wouldn't you agree? And that's what we specialize in the F-Dates membership, which is available through AmazingAccuracy.com website. Now, when you want to time the markets, what could be better, knowing the importance of cycles, than anticipating when those cycles are most likely to occur? We can calculate it with a very high degree of accuracy, which our cycle turn dates are, very high accurate turn dates. But nothing is 100%. There are surprises all the time in the markets. But we utilize our cycle turn dates, which we call fondly F dates, for future dates because we get them in advance. We know in advance when to expect the next likely swing to occur on the daily chart as well as the weekly chart. So I plotted on this chart and I chose the Australian dollar. These are all the markets that we put, including the mini, S&P mini. All of these, if you'll look at this list, we have, let me see if I can expand it for you here, if it makes a difference, probably not. But you'll see we have the S&P mini, we have Australian dollar futures. These are futures. All of these are futures. We don't have stocks on this website. I use the ES futures here when I want to deal with the S&P 500 stock market, just strictly to trade the SPY. But you can trade, for example, we have the Australian dollar. So you can definitely go and trade the Australian dollar ETF, which I believe is FXA. You have FXB for the British pound, but these are all futures. British pound, Canadian dollar, euro, Japanese yen, coffee, sugar, cotton, crude oil, gold, silver. You have cattle, live cattle. You have live hogs. You have the bonds. You have corn futures, soybean futures, wheat futures, and platinum. If you only trade stocks, you can use these for the stock equivalents. So you can look for stocks that track a certain futures contract very closely. There is the FXB, the FXC, I believe that is. Yes, the euro, I'm not quite sure what that is. Maybe it's FXE. Correct me if I'm wrong. You have the Japanese. So there are ETFs for several of these. You got one. You got them for like crude oil, but we only provide the futures contracts within the membership. Just an FYI for you folks interested in this kind of stuff. Now, I have plotted the last 4 F dates that has appeared on this report. And these dates were provided ahead of time so that the members knew to look for October 15th plus, October 18th, October 23, October 30. These little symbols like plus and the star here and the plus here, these just simply give us biases. So the plus says that, okay, first off, let me just say that when we expect a cycle swing, you have to understand that there are forces in the market that can cause the cycle to shift. We allow a shift of only one price bar in either direction, and no more than that. Otherwise, it's too sloppy. And this is the same for the weekly chart. So if we were looking at weekly turns, again, if we were expecting a weekly turn, let's say right here where this vertical white line is, well, if it occurred the 1 bar over, that's fine. It's still within that 1 bar shift. You look at the big picture, the weekly cycle, major trend bullish, major trend bearish. Then you go to the daily because you want to kind of go in that direction and you want to focus just on those cycle turns that will go in that direction. Puts the edge in your favor. So back to the daily. So I have put the very last 4 that were reported on our last couple of reports. I believe it doesn't go back 2 reports. It goes back, let's see, 10, 18. Okay, so it goes back to the last 4 reports. So we recorded or released 1015 plus, and 1018 showed up on the 1011 report. We start from there. And this last report, which was done today, extends out until November 12th. But again, those dates are for the members, so I only put the last one that has already occurred right here, 1030 plus, for the general public. But you keep watching, my videos on here. I provide a video from time to time where I actually give you the next turn in expectation in advance for free. So you need to subscribe and click that notification bell. Very important you click the notification bell. Why? Because if I tell you that we're looking for a swing top tomorrow and you don't get it until 3 days later, oh well. But the notification will let you know, hey, I just uploaded. You better go check it out right now if you happen to be interested in those stocks. And I usually do that for stocks. Here in the membership, these are futures. All right, so, and by the way, this lesson applies to any kind of market, but the F dates here are strictly based on what I calculate them on. And in this case, these F dates only apply to Australian dollar. The British pound has its own F dates, cycle dates, F dates, cycle dates. Okay. Canadian dollar has its own. Crude oil has its own. The T-bonds has its own. The S&P 500 has their own because they have different cycles. Remember those indicators I showed you? The patterns were different. Okay, these F dates are cycle turn dates where we anticipate when that cycle will turn again in the short term and the medium term, which is the weekly. And we do this so that we can anticipate an opportunity to get in with the current cycle trend. And I'm going to show you how effective it is based on just the last 4 that we have here. And again, I'm going to give a disclaimer. I got to give a disclaimer. Nothing is 100% accurate. Nobody has that. Nobody has the ability to predict to the price bar every single time. You're going to be off once and twice here and there. That's just the way it is. If you're really good, and we're really good, sometimes things are not going to hit. But the beauty of it is, which I will discuss, is we have this thing called the guidelines. And the lessons are on the website. They're within the membership. But the guidelines, I'm already sharing those with you, and I'm going to share them with you. It's very simple. In this case here, let's start with the first one. We had an F date for 1015 plus. That means we were expecting a swing, top or bottom, doesn't matter. We don't care until we come to that day. Then we examine the bar. As you learned in the previous video, that we have potential swing bottoms or potential swing tops. So when you get to the date, look at the price bar and ask yourself, is that a potential swing bottom or is that a potential swing top? Because this price bar happens to be inside our F date window or our cycle turn window, which again is just one bar. Remember that? Keep that in mind. That's your window. That's your window of expectation, okay? So right here, I'm going to expand this right here so you can see this. I'm telling you, these videos are packed with information if you really, really want to be a good market timer. Even if you never use our cycle turn dates, you will learn a lot about the behavior of markets and trends. And this should help you with your trading, your market timing. As we arrive to 1015 plus, which is saying we're expecting a swing to occur, the plus simply says that if it is going to be off, it is likely, not guaranteed, but it has, there are indications, additional indications to suggest that it may likely be late. That's the plus. A minus would be early. Well, when we are in 1014, for example, okay, 1015 shows up and takes the low out of 1014, you already know it's not going to be early, right? You already know. When we got to this 1016 price bar, we already knew that this is the only potential swing bottom that could possibly produce a confirmed swing bottom for that date on the report. And the probability is super high that it will produce a swing bottom because we pre-calculated that it was likely going to happen at this time and put it on the F date report. But as far as trading goes, Remember what I said about trends. Was this a potential swing, higher swing bottom or a potential lower swing bottom? Well, we simply just go back to the last swing bottom, which was right here, and we see that it is a potential lower swing bottom. That means that the trend is down. Remember, lower swing bottoms and lower swing tops is a bearish trend. Should you be buying a bearish trend? No. So even though we were expecting that there is likely, notice the words I use here, expecting, probable, likely, never say it will for sure do this, with some exceptions. So in this case, when that price bar, we knew it was likely going to make a swing bottom. We would not be buying this market unless you just like to counter trend, and that's on you. I don't encourage it. I don't teach it. The opposite is what I teach. Our guideline says for us to take a swing bottom, a potential swing bottom, and treat it as a buy setup, it needs to be a potential higher swing bottom. And remember what an F date window is. You take the date and you can allow minus or plus one trading day on a daily, one trading week on the weekly time frame. That is our guidelines. That's what a buy setup is. Potential higher swing bottoms, because remember, a bull trend is higher swing bottoms. If you were already short this market, you would at least know to expect a move against your position. So if you don't want to give up the profits you now have another way of tightening up your stops when you're expecting opposing swings. And you'd be expecting it because you have the F date that tells you that, hey, we're likely going to have a swing bottom here, the potential swing bottom and the turn date. Now, the next one that came up on the report was 1018. Now, 1018 was this high right here, and it was a potential swing top. Because it was a potential lower swing top, for those who are using the F dates, that means that this 1018 here was a sell setup. And how our guidelines work is that if you want to take the sell setup, you would only enter if it confirms. If it confirms. And remember in the previous lessons, to confirm requires that you have a new potential swing bottom price bar. Remember that? If you have a potential swing bottom that follows a potential swing top, that potential swing top confirmed. In this case here, we did, but it was an outside bar. Remember the lessons of the outside bar? So the outside bar made a higher high, which now made the inside bar a potential swing top and a potential swing bottom. Well, the potential swing top negates the previous potential swing top, and it becomes now the new sell setup because it is within that F date window. It is within one bar of 1018. It only, in this case, not always, but in this case, it only went up a little bit higher to take out the 1018, and then it reversed and plummeted. The point of the matter is that you'll notice we ended up with this swing here for this F date, and we have this potential swing top here. Now, As a potential swing top, it's a potential lower swing top when compared to the previous confirmed swing top. You see that? So the potential swing top is a sell setup. The potential swing bottom of this price bar would not be a buy setup because it's lower than the previous low. And remember, a buy setup has to be a potential higher swing bottom. So here, this price bar was a sell setup. And so if you choose, you could sell when it confirms. And when did it confirm? It confirmed right when we had this new potential swing bottom price bar right here. Once it went below its low here, we could have just gone ahead and sold. Let me put a line here for you. All right, so we could have sold there. I don't like this line. Give me another line. Let's see, how about this one? Better. All right, there we go. I'm gonna go across here. Okay, so as soon as price crossed this line right here, this confirmed as a swing top within the F8 window. Perfect. You're in another sell. Okay, you're going down. Now we come down. Let me get some of this drawing off here. Then we come down to another F date, a very interesting F date. It's called here a $ F date on the report. It's got this little asterisk. All that means, folks, just in case you're interested in knowing, but if you're in the membership watching this, this is part of your training. That asterisk just simply means that we had additional indications that actually strengthens the probability that we'll have a swing on that date. And oftentimes we find that they're very significant turns, but not always. 50% of the time maybe they're significant. Otherwise, they're just your basic everyday swing bottom or swing top. But for it to happen, the probability is a few percentage points higher. It would be like saying, well, normally F8 cycle turns are 85%. Well, this kicks it to 91, something like that. So that just a little indication to just say, hey, I got some extra information that says, hey, this looks really, really good. In this case here, I want you to notice that on October 23rd, which this date is, we had a potential lower swing bottom price bar. A potential lower swing bottom. That means there'd be no buy setup here because this would be counter trend. However, what happened here on the next day, it formed an inside bar. So it didn't go high enough to confirm this as a swing bottom, but instead 1024, which still is within this time window, has now put itself in position to be where the market would then reverse and go back down. We call this pattern in the membership a pause formation. And I just wrote pause here, but it's pause formation. And what that means is price comes down, hits a bottom here, it pauses. It doesn't quite reverse and go up, but it does go up somewhat, okay, to form this inside bar. And then the following day, the trend resumes. Now, these are tradable. And they're tradable like setups. And let me explain what I mean by that. With a pause formation, if the inside bar itself has its low violated, and not its top, but its low is violated, it would confirm that potential swing bottom here as a swing bottom because now price is resuming down again. There was some kind of a top, but remember the video I showed you that with inside bars, something like this, you'd have to go to a lower time frame to see it. And we're going to do that right now, and I'm going to show it to you what's going on here. So here you can see, and I've already marked it up, but this is the 1023 bottom low. This is a 4-hour chart. So here was 1023 made this bottom. Here is the inside bar's top, 1024 top, right here. Notice what we have here. We have on the 4-hour chart an obvious lower swing top, lower swing bottom, lower swing top, lower swing bottom. We still have that bearish trend. Even though we could not see this clearly on the daily chart, here on the 4-hour chart, which just is the next time frame down, I use a 4-hour. You'll notice that we had the top mid-range of the 1023 bar, which was just this very long move down here. It came up, made this top, and then came and at the end of the day, it made this bottom that did not quite go lower than the 1023 bottom. That formed this inside bar right here. Okay. That formed that inside bar right there. Now, because I've been looking at these charts for 40 years, I immediately saw the 1023, I saw the inside bar, and in my head I'm going, well, we got a pause formation. You have an inside bar, potential swing, pause formation. All I'm looking at is a break below the low of the inside bar for a trigger. That's all I'm looking for here. Only because this is inside of a cycle turn window. If it wasn't inside a cycle turn window, I wouldn't even pay attention to it. But the cycle turn window is kind of an alert. You can certainly do that without even caring whether there's a cycle turn window. Just look at every inside bar and play it as if it was, and that would be up to you. I happen to like that extra confirmation, that extra security, warm, fuzzy feeling that we are expecting the market to make cycle swings at that particular time. All right. And that's what happened here. So on the 4-hour chart, when prices start on October 25th started moving up and then came and broke below the low of 1024, that confirmed this corrective swing to the downside. Although we don't call this here, we don't technically call it a swing top price bar because it's not sticking up like these are, like this one or this one or this one, which are really obvious. It still functioned the same way as the end of a correction and the resumption of the downward move. And if you want to time it with super precision, and that's what we're about here, is precision, because that means lower risk, higher profit potential, getting in as early as you can without exposing yourself. You can easily see that you're looking at entering here, confirming this cycle swing, and at the same time, you could have your stop loss just above that 4-hour swing top right there, and that is your whole risk right here. And if you say, well, that's too close, sure enough, then go right above that inside bar. Either one is fine. You're limiting your risk, but now you're getting back into a trend with a high probability of continuing because you're dealing with knowing how trends work and that you have these cycles. And here's another thing too. On our report, the next cycle we're expecting after 1023 is down at 1030. So I feel pretty good. It's not guaranteed. I have to throw that out there. It's not guaranteed. But if I'm noticing that I just got a cycle correction and resumption of the trend within this 1023 F8 window, and now I'm not in an F8 window anymore, so I'm not going to expect these price bars to make a swing. They might, they could, it's always possible. Can't always win them all, but because I'm not expecting that to happen until the next F date, for example, well, I notice that 1030 is, a couple of days away. I'm feeling pretty good about this trade. And so the market comes down all the way down to 1030. That's right here. And we have a F date. This last F date here was 1030 plus. So it's basically saying, hey, we're leaning more to 1030, and if it's off a bar, it just has a little more lean to the plus side than it does to the minus side. That's all. It could happen one bar early. It could. But I hope you understand where I'm coming from. It's just probabilities. That's what I deal with. Odds, probabilities. That's our edge, the odds. So what happened in 1030? An outside bar, right? What is an outside bar? It's a possible or probable or potential, I shouldn't say probable, potential swing top, potential swing bottom, both, right? Okay. As a potential swing bottom, it's not a buy setup for us. Why? Because it would be a lower swing bottom if it confirmed. That's not a buy setup. It has to be a higher. It's a potential swing top. Well, it's definitely a sell setup because if it confirmed, it'd be a lower swing top. And so if we felt, yay, if this thing confirms as a swing top, I'm going to go and get in on the short side again. I'm going to add to my sell position. But if it confirms as a swing bottom, you might say, I'm going to exit the shorts that I've already been in since, right up here. See, that's potentially where we entered. Okay, really quick, I wanted to interject here in post that on the weekly chart, we did have a weekly cycle turn date for week ending 9/27 plus. And this means that the weekly price bar for the week that ends with the date 9/27, that's the price bar we're referencing. And then, the same rules apply that the window is plus or minus one bar. And in this case here, because we had that potential swing top weekly bar on the daily chart we were just looking at, there was indeed an F date for that first lower potential swing top for a sell setup. It's important to note that if the weekly chart didn't have a potential swing top based on one of our cycle dates, on the daily chart, there was no way that we would have been able to have a sell setup so early in this downward trend. We would need a little more formation, which is something you would learn about within the membership. So we got some shorts here. We got a short here and a short here. We got a couple of shorts here already, just with this example. We could, if this thing turned out to be a confirmed swing bottom, exit. And if it turns out to be a swing top, get in on the third position. Well, let's take a look. Remember this? We have an inside bar following this bar here. This is a pause, just like this one was a pause. So with a pause, we wait to see what end of the inside bar gets violated. And in this case, the top is violated. At that point, we can just get out of our shorts. And let's go to the 4-hour chart here. and see what that would look like if you wanted to go down one more level. Okay, so we have, okay, there's part of the inside bar right here. So this one is the high of the inside bar. Let me mark it. Ah, the wrong line. I don't like that line. Give me, no, don't give me that one. Okay, here's the high of the inside bar right there. And this would be, yep, that's the low of the inside bar right there. And then clearly, if the price on the following day exceeded the high of the inside bar, we would get out. If you want to do it that way, if you want to use it as an exit, you'd simply get out. And we can see that that happened right there. And you'd get out at what, 65.87 when it broke? But if instead of doing that, it went and broke this low right here, you would get in at another position at 65.41. And now you have 3 or more positions in this particular market, all based on the expectations and the confirmations of these swing bottoms and swing tops. Back to the daily. Reset so it looks good. Okay. So right now in this particular situation, you may say that we are currently flat. We got out of positions because we just confirmed this swing bottom. And before I end this particular tutorial that is pretty lengthy at this time, let me just say that what also helps out if you want to decide whether you're going to let a counter move knock you out, get you out or not. I don't know how long you want to ride your trades, for a few days or you want to ride them for weeks. That's up to you. But the thing is to consider the weekly time frame, the next higher time frame up. So if you go to a weekly time frame, and these dates, by the way, are for the daily. I just did not shut off the weeks for those, so it's showing up on both time frames. Let me get that off of there, because they don't apply to the weekly, they're daily dates. Visibility, get the weeks off. There we go. All right, here's the weekly chart of the Australian dollar. And it also has its swing bottoms and swing tops. It's much more long term. So, for example, you see that the Australian dollar has been in this strong bear trend going all the way back here to the end of September. The end of September. So all of October, we have been moving down. Now, on the F-date report, we happen to have weekly turn dates on here as well that alerts us to a probable swing tops or swing bottoms when they are going to occur. All right. So again, same rules apply as the daily, but if you happen, my point is, if you happen to notice that the current weekly swing bar is a potential swing bottom, and there is a possibility that weekly prices could confirm this and go higher, then on the daily, that may help you determine whether you want to go ahead and get out of your short positions at the first sign of a confirmed swing bottom, or to just give it lots of time and lots of room and ride it out because you don't think there's going to be a swing bottom on the weekly because you have no indication of that happening. So you can see that it's very helpful to have this kind of information on hand, but you also want to use common sense on how I just explained the positioning of cycle swing bottoms and tops, where they are in relation to previous swing bottoms and tops, to only take those swing bottoms and tops that go in the direction of the trend, and how you can also utilize them to get out when you think that the market's now going against you because there's an opposing swing that is now in the opposite direction of where you're trading and so forth. All right, folks, well, that's about it for this video. I hope you enjoyed it. I hope you took something from it. There's a lot of information here. It's all about timing with market cycles. And in this case here, I shared with you F-date cycles that we happen to have, but you can utilize this information to help you even without cycle turns. You just utilize some other things that would help you guess or believe that the market is likely going to make a swing. And remember that just stick with the trend. You know, go ahead and enter if you want, if you're forming a higher swing bottom and the weekly looks like it's going to continue going up, or you sell when you have lower swing tops and the weekly looks like it's going to continue lower. Or otherwise, you can also incorporate these short-term and intermediate-term cycle turn dates that we offer, for example, within the membership, as well as the Hearst cycle charts, such as these right here, that gives you a very good indication as to where prices are going. Please subscribe if you haven't done so already. Click the notification bell. And please, guys, give me a like. Just take a moment and say, we like it. And click that video. It helps. And I'll see you in the next video. Bye.